The biggest threat to your money right now isn't a stock market crash, it isn't inflation, and it isn't the recession the headlines keep promising you. It's the bank where your paycheck quietly lands every single month. Right now, while you're watching this, the American banking system is sitting on a problem most people simply cannot see. It is hundreds of billions of dollars in losses hidden in plain sight on the books of banks you walk past every day, and by the time everyone else finally sees it, it will already be far too late. My name is Marcos, and I've spent the last decade obsessed with one question: how does money actually break? Not the dramatic Hollywood version, but the quiet version that wipes out ordinary families before they even understand what happened. Most finance channels will just tell you to stay calm and keep on investing, but they're skipping the part that truly matters, the part hiding deep inside the balance sheets of the banks you trust. I'm not here to sell you gold, crypto, or some doomsday bunker. I'm here to show you how the machine actually works. If you want to understand what's really happening before everyone else does, you are in the right place, because this video might completely change the way you look at your own savings account. Let me paint you a picture that you already recognize. You work hard, you get paid, and you move your money into a bank, because that is exactly what responsible people are supposed to do. You assume it's perfectly safe, because the little sign on the door promises that it's insured. That insurance is real and it matters, but it was never designed to cover everyone, everywhere, all at the same moment. You never really think about what the bank actually does with that money the moment it lands in your account. But here's the uncomfortable truth that almost nobody wants to say out loud. Your deposit does not sit in a vault quietly waiting for you to come back for it someday. Banks are legally allowed to keep only a thin sliver of your deposits actually on hand at any given time. The second you hand your money over, the bank lends it out, invests it, and locks it into assets it cannot easily sell. For years, that whole arrangement worked beautifully because interest rates were low and everything felt permanently stable. Then interest rates exploded higher, faster than almost anyone alive had ever witnessed in their lifetime. And suddenly, the safe, boring bonds that those banks were holding became worth far less than what they had paid for them. When an old bond pays 2% and a brand new bond pays 5%, nobody wants the old one unless you slash its price. Multiply that one tiny gap across trillions of dollars in bonds, and you start to grasp the sheer scale of the whole. That gap has a name, and it is quietly becoming the most dangerous phrase in all of modern finance: unrealized losses. On paper, the banks are still technically solvent, as long as nobody asks for their money back all at once, and that one tiny fragile condition is the entire foundation that this whole system is standing on. Here's the part that most people completely miss, and it might be the most important point in this entire video. As of early 2026, banks across the United States are sitting on roughly $400 billion in unrealized losses on their securities. At the very peak of this mess, that number was estimated at well over $500 billion. To understand why that truly matters, you have to understand one simple but brutal piece of math. A bank does not need to lose all of its money to fail. It only needs to lose enough to spook its depositors. Imagine a simple bank with $100 in deposits and only $10 of real cushion protecting it. If its investments quietly drop in value by $15, that bank is already technically underwater. On paper, it can pretend nothing is wrong because the accounting rules let it value those bonds as if it will hold them forever. This is why a bank can look perfectly healthy on its quarterly report and be dangerously thin underneath at the same time. It keeps the doors wide open only because the loss is on paper and nobody has forced it to sell anything yet. But the moment depositors get nervous and start pulling their money out, the bank has to sell those battered assets for real. And selling at a loss instantly turns an invisible paper problem into a very visible, very public collapse. Researchers at Florida Atlantic University actually track this exact risk across the largest banks in the country. By their count, dozens of major banks have exposures so high that a serious shock could erase most of their safety buffer. These are not tiny credit unions tucked away in little towns you have never even heard of. These are regional and super-regional banks holding tens of billions of dollars of ordinary people's hard-earned savings. The most dangerous zone is banks holding roughly 10 to 200 billion in assets, too big to ignore, too small to feel untouchable. They are big enough to do real damage if they fall, yet small enough that nobody is guaranteed to rush in and save them. Here's where things get really interesting, and this is something that will probably surprise you. A banking crisis is never really about the numbers, it's about something far more fragile, which is human confidence. Every bank on earth runs on one quiet, unspoken promise that you will not all show up asking for your money on the very same day. Think about that for just a second because it is genuinely terrifying once it truly sinks in. The entire system depends on you staying calm, while everyone around you stays calm too. But humans are not exactly calm creatures when they sense a real danger to their own survival. We are herd animals, hardwired to start running the instant we see other people start running. In the old days, a bank run meant a physical line of frightened people stretching all the way around the block. Today, a bank run is just a few taps on a phone, and billions of dollars can vanish in a single afternoon. Social media now spreads pure fear faster than any regulator on earth could possibly respond to it. One viral post, one screenshot, one rumor, and a perfectly solvent bank can be dead by the closing bell. That is exactly what happened in 2023 when one major bank lost over $40 billion in deposits in a single day. Depositors tried to yank $250 billion out of that one bank in barely 48 hours. No vault on the planet holds that kind of cash, so the only possible outcome was a complete and total failure. There was no angry mob and no broken windows, just thousands of people quietly clicking transfer at the very same moment. Now you might be sitting there thinking that you are far too smart to ever panic like that. And while there is some truth to that, here is the uncomfortable reality you simply cannot escape. By the time the news finally confirms a bank is in trouble, the people with inside information have already quietly left. The smart money always moves in silence. The rest of us only find out when the headlines start to scream. You won't be early. You'll be standing in the digital version of that line, refreshing an app that no longer works. This is the part that absolutely nobody in finance really wants to tell you directly. Now let's talk about the thing that should genuinely keep you up at night, because it is the exact opposite of what you've been told. You have always been taught that cash sitting quietly in the bank is the single safest place for your money. But inside a fragile banking system, sitting passively and assuming everything is fine is its own kind of hidden risk. Doing nothing always feels safe, but doing nothing is still a decision, and sometimes it is the most expensive one of all. Here is the contrast that quietly changes everything once you finally see it clearly. The person who keeps every single dollar in one account at one shaky regional bank feels safe, but is completely exposed. The person who understands the system spreads their money out, watches the warning signs, and sleeps soundly through the whole storm. Remember the magic number that actually protects you. The FDIC insures up to $250,000 per depositor per bank. Anything above that line, inside a single failed bank, is not guaranteed to ever come back to you at all. It simply becomes a claim in a bankruptcy line, and you might wait months for pennies on the dollar. Most ordinary people are nowhere near that limit, and honestly, that is genuinely good news for them. But business owners, families saving for a house, and anyone with real savings can blow right past it without even realizing. Let me give you a number that puts this whole danger into real perspective. In the 2023 failures, regulators had to step in with emergency measures precisely because so much of that money was uninsured. They essentially promised to cover even the uninsured deposits, which quietly set a very strange new precedent. But a promise made in a panic is not the same thing as a law, and it can quietly vanish the very next time around. The system survived that round, but it survived on confidence and bailouts, not on solid foundations. And the underlying cracks, the unrealized losses, and the commercial real estate exposure never actually went away. Lower interest rates would ease the pain, but every time inflation flares back up, those same losses come roaring straight back. Here's something that might genuinely blow your mind. If this all sounds like fear for the sake of clicks, let me ground every word of it in cold, documented reality. In the spring of 2023, three large American banks collapsed in a matter of just days. Silicon Valley Bank, Signature Bank, and First Republic were all gone, with hundreds of billions in combined assets. Silicon Valley Bank alone was the second largest bank failure in the entire history of the United States at the time. It went from looking perfectly healthy to being completely seized by regulators in under 48 hours. Customers who felt completely safe on Monday were locked out of their own accounts by the end of that same week. These were not fringe institutions. They were respected, regulated, and packed with sophisticated, wealthy customers. And the cause was almost exactly the story that I just walked you through step by step. They bought safe bonds, rates rose, the value cratered, depositors panicked, and the whole thing unraveled in days. Now fast forward to exactly where we are standing today, in the middle of 2026. Banks are still carrying close to $400 billion in unrealized losses on their books right now. The Federal Reserve's own stress tests for this year are built around a sharp crash in commercial real estate prices. On top of that, this year's scenario assumes a steep, stubborn yield curve, which simply means even more pain for the banks. When regulators design their nightmare scenario around the exact risk in the room, you should probably pay close attention. By one university screener, dozens of the biggest banks still carry real estate exposures several times larger than their entire equity. Analysts have flagged specific names, like New York Community Bancorp and Zions, as unusually and uncomfortably exposed. One finance professor described the regional banking sector as a tinderbox just waiting for a single spark. Empty office towers from the work-from-home era are loans that may honestly never be fully paid back. Roughly $1 trillion of these commercial property loans are coming due and need to be refinanced at far higher rates. Many of those buildings are now worth less than the loans against them, which is the textbook recipe for a default. And those shaky loans sit on the books of the very same regional banks already weakened by unrealized losses. It is the same wound in the same patient that very nearly killed the entire system 3 years ago. This is where the math really starts getting genuinely uncomfortable. So what do you actually do with all of this, beyond just lying awake at night worrying about it? First, understand that knowledge itself is your single greatest form of protection in a moment like this. The people who get crushed in a crisis are almost always the ones who never once saw it coming. You are no longer one of those people simply because you made it this far into this video. Second, know exactly where your money lives and whether it sits comfortably under that insured limit. If you hold more than the protected amount in one place, spreading it across several institutions is a basic, sensible move. Treasury bills bought directly from the government are backed by the full faith of the United States, not one bank's balance sheet. A simple money market fund or a brokerage sweep account can also spread your risk far beyond a single fragile bank. Third, stop treating your bank as some sacred, untouchable fortress and start treating it as the business it truly is. A business can be run well or run poorly, and you are completely allowed to ask which one yours really is. Look at how exposed it is to commercial real estate and how much of its deposits sit above the insured line. None of this is about panicking, pulling out every dollar, and hiding the cash under your mattress. It's about becoming the calm, informed person in the room while everyone else is reacting on raw emotion. Calm is a strategy, and in the middle of a panic, calm is the rarest and most valuable thing you can own. Because in every single crisis in history, wealth does not simply disappear, it quietly transfers from the unprepared to the prepared. The only real question left is which side of that transfer you intend to be standing on. Quick, honest note before we wrap up. This is education, not personalized financial advice, so always think for yourself. Remember how I started by telling you that the real threat isn't the crash that everyone is watching for. It's the quiet fragility sitting inside an institution that you were taught to never once question. The banking crisis isn't some distant storm on the horizon. The cracks are already here, in the data, in plain sight. You just spent the last few minutes learning to see what most people will only understand in painful hindsight. While the crowd waits for permission from the headlines, you already have everything you need to move first. And awareness is not fear. Awareness is simply the very first move of every single person who comes out ahead. That makes you the type of person who acts before the headlines instead of long after them. So open your eyes, check where your money sleeps tonight, and make one small smart decision this week. And if you want to know exactly when you could feel safe with your money, watch the video on your screen right now.